Investors are grappling with how limited the next set of Fed interest rate increases may be ahead of next week's Federal Reserve policy meeting in Washington. Investors are already grappling with what the next U.S. interest rate hike cycle will look like in years to come, with some pointing to the 2015 to 2018 campaign as an example of how shallow and short-lived it may turn out to be. The year 2018 was the last time Fed officials were able to deliver multiple rate increases in 1 year and, back then, the U.S. was still in its longest economic expansion on record. By 2019, policymakers were fretting about the risks of a recession and, instead of hiking even further, they delivered 3 so-called preemptive rate cuts to avoid a downturn. Beyond how quickly the central bank will taper monthly bond purchases and the timing of the first rate hike, the next obvious question for investors is where the Fed funds rate target will end up. Considering the U.S. is now in a period of persistently higher inflation that likely requires higher rates, FHN Financial is just one of the firms that sees the Fed funds rate target as likely to be stuck below 1.25% through December 2024, implying the Fed hikes only 4 times by 25 basis points each, versus the 1.8% median forecast of FOMC officials by then.